Uh-oh, banks are failing. Does that mean the real estate industry is collapsing next? Hey everyone, I'm Brian.marino, the Real Realtor. And today what I want to do is talk about what's happened in the banks, with the banks in the last few weeks, and how that's going to affect the real estate industry going forward. And I want to compare that to what happened 15 years ago. So basically, we want to know what's exactly happened with Silicon Valley Bank and then Signature Bank. And what happened is currently right now we're not in a recession. However, if you've paid attention, more and more people are using their savings money to pay for bills. So it's a natural course of action that people are going to go to banks and they're going to withdraw some money. So what happened in these two banks is people were starting to take out more and more money. And typically what happens is with all the deposits people make into banks, only 5 to 10% of that is kept in cash, and the rest, because the banks are a business, they're going to invest that money someplace else. Unfortunately, a little more than 50% of that money was invested into bonds. Now, on the surface, that isn't bad because it's a lot of them were government-backed bonds, and that's usually a secure investment. The problem was most of these bonds were purchased more than a year ago. You see, a year ago, interest rates were very, very low. And so that means the yield on the bonds is low. If everything had stayed that way, there'd be no problem. However, what's happened over the last year? Well, I think we all know, unless we've been living under a rock, that interest rates went sky high. They went from, between 2.5% to 3%, now to 6.5, 7, sometimes, probably around 7% was where they topped out at, give or take a little bit. So what happens now is when you buy bonds in the current environment, those bonds are going to be worth more money. So what happened is the banks, in order to pay the people the depositors, they had to convert a lot of these investments. And since they weren't worth that much money, now they have a bit of a problem. And the cash reserves went up pretty much very quickly. So now word of this started to get around, and what happens is you get a bit of a panic and what's called a run on the bank. When you have a run on the bank, that means people are taking out all of their money, and the bank isn't liquid with all this money. So now they had to convert all these low-yielding bonds, and that caused a problem, and they couldn't do it, and that's basically why these banks went under. You sort of had the chicken and egg phenomenon. People were taking more money out just as a natural course of the economy. The cash reserves went quickly. Now they had to go convert the other investments, and word got out that there was a problem here. Unfortunately, these two banks were mismanaged. I even heard a possibility that, particularly in Silicon Valley Bank, that 11 of the 12 people on the board of directors actually had no banking experience at all. Oh God, that's just terrible to hear. You really don't want to hear that. Um, and also, in addition, there is rumor that some, although I don't know how much, and I don't know if this is true at all, some of the money that they invested these two banks was also in cryptocurrency, and I think we all know the instability in that market. Um, but how does this compare though to 2008? In 2008, this is a totally different situation. In 2008, we were in a recession, and in real estate, prices had topped out about 2 years earlier. And at that time, the joke in the real estate industry was basically just put a mirror under their nose, and if it fogs up, give them a mortgage. That's how easy loans were to get in 2006. They were giving out 100% loan to value loans and even higher than that. That means people had to put little, if any, money down in almost all cases, including closing costs. So by 2008, prices were dropping precipitously at that point, 10, maybe even as much as 20%. So now the amount of money that people owed was a lot more than what the house was worth. They needed the money. They couldn't get it out of some banks. They lost their job. So now a lot of these people walked away. So these loans are another performing asset for the bank, for the bank's business model. and now they weren't getting the interest money payment on these loans, and so now so many of them defaulted, and that caused so many banks in 2008 to go under. Big difference between what's happened then and what's happened now. Another little wrinkle in this, if you want to call it a wrinkle, another factor I would say, is there's a company called the FDIC, and that stands for the Federal Deposit Insurance Corporation. And has a little. I remember when I was a kid, when banks wanted you to put money into them, when they paid 6 or 7% on savings. Yes, they did. People younger than me, they did pay an incredibly high amount on savings account at the time. But I always remember the TV jingles: FDIC insured, da 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 da. But anyway, I digress. The FDIC insures loans. They have a few purposes, but one of them is insuring insuring deposits up to $250,000. And also, what they do is they oversee the banks to make sure they're run pretty much regularly, and as they should be run. That's two of the bigger purposes of the FDIC. One of the things that I learned is that there's a reason why people who are rich, who have more than $250,000 cash, they spread it to different banks. What being insured up to $250,000 means, basically, if I have $300,000 in a bank and the bank goes under, the government's only required to give me $250,000 back. So whether or not someone had more or less than that in the current banking situation, the run on the banks, everybody wanting to pull their money out, is what caused the problem. Also, what happened after 2008, the FDIC also instituted some fees on all transactions that banks tend to do, and built up a reserve in order to help protect against what happened in 2008. And I have to be honest, I think that was a good thing. I think that they have done their job, and one of the reasons that I believe that is because another bank in the U.S., First Republic Bank, they asked for some bailout money help, which on the surface seems like a bad thing, but the government gave it to them, and that's only been in the past few days. And in addition, I believe, if my information is correct, on Silicon Valley and Signature Bank, that they even insured a lot of deposits even above the $250,000 mark. So what that tells me is the safeguards they put into place have come into play, and that everything's working the way it should. Can't complain about that. The important thing I want to note is also in Europe, there is a bank called Credit Suisse. They also had problems a few days ago. They got some bailout money. So I guess we've sort of learned from our mistakes, is the takeaway that I want you to take from this. Could it be worse? Yeah. Could it get worse? Yeah. If there's a lot of unemployment, absolutely. I don't think that's the case. And could more and more banks go under? The government couldn't have collected that much FDIC money, so to pay out these to pay these banks and these depositors, I should say. So time will tell. My gut feeling says I think we're okay, at least in the short term. Obviously, that could change should all of a sudden there'd be a lot of run on the on people wanting to take money out of the banks. Next week, the Federal Reserve meets. An interesting phenomenon that's happened is interest rates have actually dropped between 0.75%, maybe 1% in some cases. So someone getting a mortgage right now in the next few weeks, if you can lock in, I would definitely do so. We don't think that's going to last that long. But the rumor was that the Federal Reserve was going to raise the interest rates about another 0.5%, 50 basis points. Now it's looking like either 0 or 25 basis points, 0.25% is what the rumors are. What does my gut feeling say? I think it's going to be 0.25%. They need to still do more to tame inflation. However, if they go and do not make any increase, that's sort of an indication to me, an admission that they're worried about the banking situation. So my guess is 25 basis points. It's like splitting the difference here. So how does that apply to real estate? Well, like I said, mortgages are going to not be a problem to get. Actually, rates have gone lower. And yeah, okay, a few banks went under, but guess what? In 2008, people still bought homes. They still bought homes. They went to other banks. And homes were still selling. The real estate market is tremendously different right now. The low inventory is causing still prices to hold up despite the interest rates. And prices, I'd say, are pretty much flat. That's what I expected last quarter going forward through this year, and that's pretty much the case in my area on Long Island. They just announced in Nassau County had the first ever decrease of in real estate prices in about 10 years or so. You know how much that was? Less than 1.5%. That's almost negligible. Suffolk County, the other county where I am, there was an increase of 1.5%. So again, nothing major here, nothing going on. The real estate market is alive and well and healthy, and actually, because of these bank problems, if you locked in right now as a buyer, your interest rate would probably be a little less and a lot more tolerable. So again, I hope you get some value out of this. I hope you like and hit the like button. Follow me for more, especially on YouTube. Brian Marino, The Real Realtor.